Hello and welcome to KYC at NDTV Profit. I am Sharad Dubey and with me is Anushi Vakharia. And today in our KYC show, we'll have a company called EFCI. Of course, this company, why we have called this company and why this is there in our show. The first question is, of course, astute investors have started taking positions in the company and not much in terms of shareholding returns. But the first question remains is, what made Sunil Singhania's promoted entity, which is called Abacus, increase stake in this counter? That's something which the entire street wants to know. It's just a 3,000 odd crore market cap. What's there in this company? That's what we'll be looking at. The second question, of course, Anushi, would be that overall, you see, what are the synergies playing out after the merger of the interior arm? They recently announced that. So that we'll be working on that. Is it a high margin business or not? We'll be having those questions as well. Apart from this, what would be the incremental benefits actually playing out when it comes to the explosion of the GCC segment?
And this is a big growth area that we're looking at.
It's a very big growth area, Anushi,
Yeah.
and GCC is the global capability centers, if I'm not wrong, right?
Yes.
So this is a very big thing when it comes to India's growth story, especially where you can measure the growth. Apart from this, how the demand trends and client confidence looking like? I think, Anushi, they have some marquee clients also to look out for, and the guidance for seats, that's a very important parameter generally we see of these co-working space companies. So these are the important reasons, but I'm sure there are some more details we need to know. Is it a fully co-working space company or does it have some more arms?
Yeah, with that, let me just start off with what this company essentially does. So it has about, as you spoke about interior business, also a new growth driver. With that, it is involved in the leasing, design and build, as well as furniture space. This being the more recent one that we are looking at. Incremental revenues have just started from H1 FY26 itself. In terms of the mix also, if we see so far, the highest mix so far is from the leasing. We are looking at about a 51% of a contribution coming from here, while design and build is about 44% of a contribution. And here in this particular segment, they're anticipating more than a 50% plus of a jump going forward. So interesting space to watch out for. Furniture space, currently the contribution is 5%, but over the years, how does that increase substantially is something that we should be seeing. These are a couple of key clients in picture over here: Bajaj Finserv, Godrej, Mahindra, Voltas and Whirlpool, which showcases the kind of credibility that it has built over the years. So that's one of the key clients that we are looking at. But Sharad, even in terms of key numbers, if you are seeing a lot of addition that has happened, right, in terms of where the seat addition is concerned.
So Anushi, the thing is, when we track these working space companies, so these are the operational parameters we track. What do you mean by these seats, 68,000 seats? These are the amount of co-working space seats we are talking about?
Yes, so these are the operational seats that they have, and they want to increase this to about 20,000 plus is the kind of addition that they're looking at. So that's with regards to overall seat capacity that they have so far, and this is with an occupancy level of 90%, which if you just take a check in terms of where the peers are concerned, it's considerably higher. So what is leading to this higher occupancies is also something that we should be asking the management, who will just be joining us later. But coming to the profitability, it's one of the only few profitable companies in this particular space that we have been looking at. A lot of recent IPOs have come over the course in this co-working space picture, and so far they've not clocked in profits. So,
and Anushi, you spoke about the GCC numbers. Look at this number by ICRA. That's a huge number, 50 to 55 million square feet by FY27.
Absolutely.
That means the industry is really growing very strong. That means there are a lot of, you could say, tailwinds coming into it. Interestingly, Sunil Singhania related promoted entity also for our viewers. It's called Abacus. They have also increased their stake, and it's roughly almost 1% and this accumulation was seen in the month of October as well, and roughly 40% of office demand is coming from this GCC segment. So it's pretty interesting when you speak about this company and where it's lying around, and it's giving a flexible kind of product offerings coming in. But in our show, let's explain you the important parameters where we judge the company in KYC, and there are 8 parameters which are there: income statement, balance sheet, cash flow and return ratio. These are the numbers which we look at. But apart from that, we also look at shareholding, street cred, which is nothing but the shareholding returns which have come over a period of time. The valuations, we compare that with peers to see whether the relative valuation is cheaper or not. And lastly, the outlook, what the company has stated, what the industry is going around, and then we give our ratings to it. But Anushi, to start with the income statement, the company has come out with its quarterly numbers also. So what are you actually gathering from there?
So if you just take a check in terms of what's happening with the income statement, we're looking at a 150% plus growth in this last 2 years period itself. So healthy trajectory there in terms of how that particular metric is shaping up, and now with the addition of the furniture business also, how that would contribute substantially over the next few fiscal. Is this growth sustainable is the question that we should be asking. Margins more or less have seen a slight bit of dip from 54%, now that has come down to about 44%, and now then inched upwards to 50% again. So what's the kind of trajectory in terms of margins? While it is on the higher side that we are looking at, a sustainable range would help the viewers to understand the company in a better manner. Net profit also has seen a more than a 5 times of growth in this last couple of years itself. Coming to the H1 performance now, 77% of our revenue jump is what we are seeing. This is with margins at 45% in comparison with 47%, and net profit seeing about a 98% of an increase. So considering all of these key metrics, we've given this a thumbs up.
Well, that's pretty interesting, Anushi. The income statement has been good, but Anushi, while I was studying the balance sheet, there are some good points as well as some bad points, or I would say neutral points. See, the history is not very much for this company. We have just taken 2 years data of the borrowing numbers. That has gone up and that has raised my eyebrows as well. 1102 odd crore rupees coming in, but company is in expansion mode also, and how they manage the debt, that is something which we will be asking the company. But interestingly, the cash reserves are decent. There is no major degrowth coming in because they are deploying into their growth businesses, and now the furniture business is something they are also looking at. So right now, currently at this situation for EFC, I will be giving a neutral rating.
If we talk about the cash flow now, this one is also a neutral is what we are giving. Now, cash flow from operations, we are seeing about 10 crore or so figure in FY24, which then inched upwards to about 134 crores. And then in H1, it stood at about 61 crores. So in the last 2 periods that we are looking at, healthy cash flow from operations is what we are seeing. This is aided by the receivables as well. Net cash flows, however, it stood at about 11 crore or odd so at the end of the first half. So how would this shape up in FY26? We'll need more data in terms of where the fiscal years are concerned to give this a thumbs up. But for now, we've given this a neutral rating.
Well, that's interesting. Anushi, the return ratios, generally in this industry, the ratios goes between around 15 to 20 odd %. But see the spike, ROE and ROCE, both of these numbers, they have spiked up, and you could say it's maintaining the growth. FY23 is largely a low base. So if you want to look at these numbers, look at FY24 and 25, and there is a growth pattern emerging. So from my side, it's a thumbs up for EFC in return ratios.
Now, the key interest comes in terms of where the shareholding pattern is concerned. We are looking at about a 45% of a promoter stake holding. FIIs hold about 4%, while DIIs hold about 7%. And, you know, we are looking at interesting names over here. You know, as Sharad, you pointed out, it's a Sunil Singhania promoter entity is what we are seeing.
I think one more entity is there, right?
Of course. We also have Sage One, that's Samit Pratik that we are seeing. They also hold about 1.94% of stake. And it's not just in this recent period that we've seen, it's a long history that they have with this particular company. So interesting holding there as well. And apart from that, in DIIs, you also have Bandhan Small Cap Fund, which holds about 1.6% of stake in the company. So considering this, we've given it a thumbs up so far.
Well, yes, for the size of the market cap and seeing a DI participant, smart money moving into the counter. But of course, the smart money is moving in. But look at the street cred, not much returns coming to the shareholders. 1 month, you see, it's down 3 odd %. 6 months, it's just up 10%. And year-to-date performance, not much returns have come to the investors. And the company has a shorter history profile as well. So currently, based on these parameters, I have given a thumbs down in this segment.
Okay. Now, if you look at the valuations, what's interesting here is that while there are a lot of new players in the street currently, only some of them are profitable. And if you just take EFC in account, if you take the 12-month forward PE in consideration, it's about a 13 times of multiple that we are looking at. Now, this is on the attractive side considering the kind of growth picture it has had in terms of where the income statement numbers that we just pointed out. 13 times, this is in comparison with Office, which currently trades at about 31 times, which has a similar kind of a growth trajectory as well. But if you look at something like a Smart Work or IndiCube, they're not yet profitable. So comparing them wouldn't be prudent, but just taking this into account, it's a thumbs up that we are seeing, right?
Well, yes, Anushi, and this is a relatively new sector for the markets.
Yeah.
Let's say 2 years history is there. Most of these companies have been recently listed, say in the last 1 year itself. You're tracking the sector, right? And apart from this outlook, that's our last parameter, Anushi. And The outlook overall, we could say future specific, the high margin interior business is something which we'll ask the management also, because there's a restructuring which was announced and now this is getting merged back to the company. Also, Anushi had discussed about the GCC industry and how importantly it's exploding in India.
Right.
And the way the foreign companies are setting up their centers. Each day we are hearing news flow from Hyderabad, Pune, Bangalore. So that's an important thing. And there is a strong inquiries coming from leasing and design build segment. To just simplify it for our viewers, leasing is like as it is, the fitment comes which a company gives. But design and build, it gives you, you could say, some kind of customization. That is why there is a two division of this revenue segment. To simplify it for our audience, 68,000 seat capacity. And Anushi had mentioned, I think 20,000 more seats could be added going ahead.
20 to 25,000.
20 to 25,000. Yeah. And diversification in the non-West markets. That's something we'll be looking out for, because most of the business is situated in the western part of the country. But let's give in to the rating parameters, Anushi, which we had discussed. I know we could just figure out what are the important things. Income statement, yes, there were some.
It was a thumbs up that
it was a thumbs up, basically. Yes, that's all. It's a plus one here. Balance sheet and cash flows here. It was neutral, right?
Yeah.
But return ratios you picked out, it was pretty good.
Return ratios were strong, is what we are seeing. So there's some bit of a correction over here. Income statement, a thumbs up.
Yeah, now it's correct. Yeah.
Yeah, and neutral ratings for these two. Coming to the shareholding, also we have given this a thumbs up, considering the DII participation along with a stable shareholding that we've seen. So overall, if you just take a net figure, 5.5 is the rating that we've given out of 8 for this company.
So that's on the higher band generally whenever we host this show, the KYC. So this is also on the higher band, but of course the returns have not come for shareholders. So that is something which we'll be also watching out for. But let's decode much more about the company, the quarter gone by. And joining us is Nikhil Bhuta, who is the whole-time director at EFC. A very good afternoon to you, Nikhil sir. One question importantly lies is about your business model. There are 3-4 angles to it, and now your results have also come in. So what were the important factors for your growth in the numbers in this quarter?
Absolutely. Thank you so much for, first of all, inviting us on the show. Yes, I mean, the growth in our businesses is primarily, factored from the fact that the way we have kind of developed our business model, which is an integrated business model that we have developed over the years. And that is really helping us to grow in all the 3 verticals, which is aligning together. And, and if you look at now all the 3 verticals independently, so as you probably know that our company is organized through 3 different verticals. One is the leasing vertical, which is where we do the managed office business. Second is the design and build turnkey contracting solution business. And the third is the furniture manufacturing business. Now, if you look at all the 3 verticals, the managed office business, as you know, all the market is today supporting is post-COVID, because post-COVID this industry has got heavily re-rated, and primarily from the fact that there is a great amount of influx of the GCC companies coming into India. And secondly, not just the GCC, but even from the domestic market point of view, people have realized that it is better to kind of hand over the real estate management, the facility management to an expert, and rather focus on their own businesses, and hence go, kind of capex light from the customer's point of view. And that is really helping this industry to grow. And if you look at today, the leasing business, the maximum of the leases which are the deals are happening towards the flex office businesses. That is what we all belong to. So the leasing business is certainly, kind of doing at its best as we speak. Design and build is also doing very well, because the real estate commercial leasing is also doing very well in general, independent of the flex business. So the design and build activity from a commercial office space, commercial infrastructure point of view is also doing very well. And similarly on the furniture manufacturing side, with the China alternate policy coming in play, Make in India policies, really working well with the present government. The furniture industry, which was earlier fairly import dominated or domestically very unorganized from a market perspective.
Right, Mr. Bhuta, sorry to interrupt you, but Considering all of these verticals that you're speaking about, furniture is there, along with that leasing, we've already seen a stable sort of a growth. Design and build also 50 to 60%, if I'm not wrong, is the kind of projection that you've given for the next few years. So considering that, I just want to understand this 50% of top line growth, is that sustainable for the next 2 to 3 years? And also help us with the margins as well, because there's some bit of a fluctuation that we've seen from this. So what's a stable margin profile also that we should be watching out for?
So, with regards to the design and build business, 50% growth is pretty much achievable, and you can see in our last couple of years, the growth trajectory. If you see, it is growing more than 50% in last couple of years.
What I also want to ask is on the capex light model, considering that they're also increasing their share of property ownership now. So with now the property ownership share increasing, how would that shape up for the balance sheet going forward, where the borrowings are concerned?
Well, that's the important portion you
Exactly.
spoke about, because the borrowing levels are already high.
Right.
Now, if they are going, and if the company is stating that it's an asset light company, now you see all of a sudden there are bigger expenses happening, then there might be more pressure in the balance sheet coming in. Of course, we saw the cash balance, that's relatively stable, but the way they deploy, is it quarter wise, or is there a lumpiness in this business model? That is something which we need to ask the management. And he spoke about the margin front also a little bit, and the concern, or I could say a good trigger, could be the interior business. So whenever, if you are having a kind of a office, now a normal office, you will have fitments will have higher margins, and now you go into much more details in the furniture segment. That means you enter a bare shell office, you can create a structure and also furniture to it. So it's like an all-in-one stop.
And the Pepperfry acquisition was also recent.
Yes, that's a very interesting acquisition. It's from the same promoter group. It's called TCC Concepts. That's the company. And recently they had acquired Pepperfry also. So we could see amongst the group companies kind of a cross-selling or some synergies happening, even though there is no announcements yet. But prima facie, if you look at it, it looks like there are synergies being developed between both the counters, which is EFC and TCC Concepts as well.
What is also interesting is, we already talked about the huge growth story that is there in terms of GCCs, right? But tier 2 expansion also, even if you look at the other sectors, companies operating in this similar space, the focus is now moving towards tier 2 cities. They're increasing their share there. In fact, one of the peers, they have like about 8% or so contribution, and they want to take it to double digit going forward. So how would that shape up, considering that they want to expand in newer geographies as well, is something that we should be watching?
I presume this company started from Pune. They had a higher exposure there. They're also having their data centers also inside that. And we will, of course, get the management again. I think the management is connected with us. Mr. Bhuta, sorry for the technical glitch, but we are speaking about your high margin business and high margin triggers. Me and Anushi were discussing on your interior segment, and I explained our viewers in a simplified manner that what your important segments are. Interior business has been restructured and merged back into the company. Now my question is, does the margin profile increase? Is the blended margin profile going to go up from here? Just explain us why this interior business restructuring happened.
No, so the interior business restructuring is, not going to affect the margin profile. In fact, the margin profile is, fairly established in the range of 24 to 26% that we make. The restructuring is just the shareholding restructuring. So the minority shareholding, which was left over, is now completely merged into the parent company. And hence, we are able to rather get the better corporate governance from that point of view. But from a margin profile point of view, the D&B segment is doing really well for us. And, we are consistently hitting margin anywhere between 24 to 26% on a net margin basis. And that we, anticipate to continue for next couple of years for sure. The way the kind of, the pipelines, the contracts, the order book in hand, we are very confident to keep achieving that margin profile for the D&B sector.
Mr. Bhuta, I'm just taking a check in terms of whether borrowings are concerned. We've seen a pickup in terms of that particular number as far as H1 FY26. Just want to get your sense in terms of how the net debt would shape up by the end of FY26. You anticipate reduction, because I believe there were fundraising options also on the table for the company. So just want to understand this piece.
So first of all, the borrowing at our company level is completely with regards to the property ownership that we are kind of building up for our own company. In a sense that our leasing business, we have roughly, right at this point of time, when we speak about 9% of the total AUM, the asset under management, is owned by us, which is like freehold. Otherwise, rest of the 91% is on a leasehold basis. Correct. So now this 9% which we have acquired properties for, for the leasing under the managed office structure, these are obviously backed by the LRD facilities, the lease rental discounting facilities, and that's the only debt that we have. We don't have any working capital or any other operational debt which is working on the balance sheet. So the only debt which is on the book right now is the LRD facilities, against which we have the tangible assets which are being created, the properties which we own, which are offered under the managed office solution. So the debt is on reduction only. Obviously, comparatively, if you look at my debt equity ratio, it is even not more than 0.4, 0.5%. So I mean, it is fairly manageable, and there is more than 2.5x, 3x of cash flow available to even repay those debts. So there is no situation in terms of the debt incremental factor on a balance sheet as on FY26, but it is rather going to reduce based on the EMI reductions happening month-on-month basis.
That's pretty interesting. One last question before we close this segment. Mr. Bhuta, the question is your client additions. There are some marquee players also included. Listed players are there. Voltas, Whirlpool make it to the list. Any important marquee client additions we have seen recently?
Oh yes, many. I mean, we have Hitachi, Red Bull. We have, like you said, Voltas. We already have Quest Corp, Tech Mahindra, and Bajaj Finance. Many of them are there already, and we are continuously adding more such marquee clients, whether domestic or GCC clients, which are getting added every quarter. And team is really geared up to kind of make our leasing vertical more stronger. And I mean, we keep on adding, as about 20,000 seats on a year-on-year basis minimum, and that is what we keep targeting to achieve for the leasing vertical.
That's pretty interesting, targeting at 20,000 seats for the leasing vertical. Thank you very much, Mr. Bhuta, to giving us your entire view on the company and the growth outlook going ahead. But Anushi, just let's revise the ratings for our audience. We spoke a lot about the company's growth, and of course raised the concern also on the borrowings front, which the management replied. But let's just revise the parameters, how it actually pans out. You see the income statement, that's a positive one, and the return ratio, that's we have given a +1. Moving on, we see shareholding, that's also gone up. Valuation still cheaper than peers. Street cred, not much returns have come in last 1 year. So net, it is a 5.5 out of 8 in the KYC rating. But Anushi, there are some key takeaways if you'd like to share.
So, of course, the first one is the 50% growth that they're seeing in the design and build space. Along with that, interior is going to be a big growth driver for the company going forward. 30% is the kind of margin that we're looking at. Borrowings also, if you see, they are backed by leased rental facilities and are fairly manageable so far. This is in line with their aim to increase the property ownership share that we are seeing.
So that's pretty interesting. Management clarified on the higher borrowings, which was raised by Anushi. And of course, the interior business and the GCC segment as a whole, we discussed everything about it. So that's all, folks. Thanks for tuning into KYC, only on NDTV Profit.